Hello everyone, Shane Newton here with Keller Williams, your trusted real estate consultant with 25 years business experience in real estate consulting and corporate finance. So today we want to talk about real estate investment and finding investment properties for income. In other words, we're going to hold these properties, we're going to lease them each month and generate revenue that way. And these are smart investments because investment properties that you buy and hold and lease to other properties, you're essentially gaining the value of the asset, the home you're purchasing, the property you're purchasing, and the appreciation it sees over time. And at the same time, you're having someone else basically pay for your investment through the rents that you're collecting. So let's look at those properties, and to start with, I want to talk about if you're looking for some resources to read about some of these investment opportunities and how to do them. One would be The Millionaire Real Estate Investor by Gary Keller, and the other would be Hold by Steve Chatter, Janice Dottie, and Jim and Linda McKissick. And Jim and Linda McKissick are actually the owners of the market center that I work with in real estate. So when we're talking about this, in the prior video that I did, we talked about the 1% rule, to where if you can find a property that you can lease for 1% of the purchase price. So for example, if you purchase something for $200,000 and you can then turn around and lease it for $2,000 a month, you're going to have a profitable investment. Now those properties are hard to find though these days. So what we're going to have to do is do a little more detailed analysis to determine if a particular property is going to be able to make us money. So how do we do that? Well, first we need to look at what are our outlays going to be in terms of what are our costs, both initially but then also on a monthly and a yearly basis. And then once we determine those costs, then we can look at what are the rental values for the neighborhood the home is in to determine if we're actually above our break even. So how do we do this? Well, the first thing we want to do is we determine the principal and interest we're going to have to pay every month on a mortgage loan. Now, mortgage rates are at historic lows, but these are for residential properties that are the primary residence. So if right now it's about 3%, well, it's going to be closer to 5% for an investment property if you're actually getting a loan. They want a little more interest on that because there's a little more risk that the mortgage company is taking giving you a loan on investment property. Second thing is that if you qualify for a FHA loan or a conventional loan, you're going to be paying somewhere between 3.5% to 5% down. Most times when you're looking at investment properties, you're looking at probably a 10 to 20% down payment is what you're going to have to make. So once we determine those amounts, the mortgage rate, our down payment, we have our initial costs, we can then put those into a model and determine, okay, here's how our monthly payment is going to be, and we can amortize that out over the length of the loan. So if it's 20 years, 30 years, whatever, we can do an amortization schedule and determine, okay, here is what our principal and interest are going to be. Once we have that, then we got to determine what's our taxes going to be and our insurance, because those are going to be factored in to the escrow account. So looking at taxes, especially here in Denton County, North Texas area, you're probably looking at 2.5% for taxes on the property every year. And then for insurance, a good number to look at, somewhere like $1,600 a year for the property. Okay, so once we've made that determination, we can pretty much factor in what our monthly payment's going to be. The other things we need to look at then are maintenance. So what is the maintenance going to be required on this property every month or over the year? So we have to factor in, what happens if a roof, get a hailstorm, we got to replace the roof. There's damage to the property, somebody, puts a hole in the wall. What if the dishwasher, what if the garbage disposal goes out? So we're going to have to be able to have maintenance built in to cover those costs. And then the last thing is we're going to have to look at vacancy rate. Now, in an ideal world, obviously we buy our property and we immediately lease it, and it's leased for 12 months and we never have any disruption. Well, that's the ideal world. In reality, there's going to be some vacancy every year, even if it's a couple of days between one tenant moving out and the next tenant moving in. So we have to put a factor in there, and I usually put in about 1 month to just to cover any vacancies that could exist. All right, so we take our monthly payment, multiply it by 12, and that gives us our yearly payment. We come up with a maintenance amount that we can plan on per year. Then we come up with a vacancy rate. Let's say it's 1 month. We can put that factor in. So now we know exactly what our costs are going to be for the year. And once we do that, now we can divide it by 12 and come up with what is basically what is our break even. What amount do we have to have each month to break even on this potential investment property? And then we can compare that to the other rents that are being charged in the neighborhood that the property exists in to see, is this property is it worth it to purchase this investment property? Now, if the rents are higher than that break-even point, yes. Even if it's $100, $200, that's fine. We can make that investment work, because over time, the rents are going to go up a little bit, and we can make the investment profitable. So again, we're looking at our costs. What are the outlays that's going to cost us to do this investment property? And once we determine that, then we can break that down to determine, here's what our break-even per month is going to be. Compare it to the rents in the neighborhood, and if the rents are above the break-even point, it's a good investment. If it's not, we probably want to either walk away, or we're going to have to put some more money down, or try to get the price of the property down some more in order to make it a profitable investment. I hope this helps. This video helps you. I hope you like the video as well. If you do, hit that like button. If you have any comments about the video or about other videos you'd like to see us do, put that in the comment section below. If you're watching this on YouTube, hit subscribe. We do weekly videos every Thursday at noon. And then we also do a weekly video every Monday where we do a market update and look at the market conditions as far as sales activity, new houses coming onto the market, and mortgage rates to just kind of get a gauge of where the market is heading based on some of the trends we're seeing. Okay. Thank you very much again for watching the video. I hope you have a great week, and we'll talk to you soon. Thanks, everyone.